Hello everybody and welcome to my monthly Vietnam update. The VN index continued its solid recovery in January, climbing by 2.3% in US dollar terms to 1,164.3 points, driven mainly by the banking sector, while the remaining sectors were unchanged. Also, the Vietnamese dong depreciated against the US dollar by 0.75% in January. Hi, my name is Andreas Vogelsanger. I'm the CEO of the AFC Vietnam Fund. Don't forget to subscribe to our YouTube channel in order not to miss any updates. Thank you. As of the 20th of January 2024, Vietnam has attracted over 2.36 billion US dollar in foreign direct investments, or FDI in short, indicating a remarkable increase of more than 40% compared to the same period in 2023, according to the Foreign Investment Agency under the Ministry of Planning and Investment. This growth is attributed to the approval of 190 new projects, a year-on-year increase of 24.2%, with a total registered capital exceeding $2 billion US dollar, reflecting a substantial 67% rise from the previous year. Large-scale projects and diverse sectors contributed to this surge, with the real estate sector leading at over 1.27 billion or 53.9%, followed by the processing and manufacturing industry at nearly 926 million US dollar or 39.2%. Investments were made by companies from 39 countries and territories, with Singapore leading at more than 1.4 billion US dollar or 59.5% of total investments, followed by Japan with nearly 297 million. Investments were distributed across 35 provinces and cities, with Hanoi attracting the most FDI, followed by Bà Rịa Vũng Tàu, Bac Giang and Bac Ninh and Dong Nai. In January, the VN index experienced a significant surge, primarily driven by the banking sector, which holds a substantial weight of nearly 40% in the index. Key players in the banking industry, including VCB, CTG, BID, TCB, and ACB, recorded a notable increase ranging from 7 to 12%. AFC Vietnam Fund has strategically excluded banks from its portfolio due to the perceived risks within the banking and real estate sectors, particularly anticipating challenges in the banking sectors over the next 2 to 3 years. This decision is rooted in observations of the consequences of the late 2022 real estate crisis. During this period, numerous banks had aggressively increased deposit interest rates to stave off liquidity crunch, and the State Bank of Vietnam, SBV, therefore intervened in the second half of 2023 to ease interest rates. The SBB also issued a new regulation, as the Circular 0223 TT-NHNN, permitting commercial banks to maintain existing loan risk classification without reclassification, and at the same time allowing banks to reduce loan provisions by 50% until June 2024. At the recent press conference, the standing Deputy Governor, Dao Minh Tu, stated that the SPV contemplating exceeding the circular, given that the current non-performing loan, or NPL in short, level has increased from 1.92% at the end of 2022 to 4.95%, despite this new regulation. He also mentioned that the SBV plans to manage monetary policy in 2024 by focusing on restructuring the credit institution system, handling bad debts, and striving to achieve an NPL ratio below 3% by the end of the year. We remain cautious and concerned that due to the SPV's leniency, the official and non-official NPL ratio will deteriorate further, given the ongoing challenges in the banking sector. This caution is supported by the SPV's announcement of credit growth of 13.5% year-on-year at the end of 2023, up from around 9.15% at the end of November. This indicates the hurried lending environment in the last months of 2023, with a monthly increase of around $20 billion. This substantial loan growth is likely sourced from larger enterprises rather than retail investors. After thorough research and investigation, there is a suspicion that some distressed real estate companies were selling their subsidiaries and/or real estate assets to a special purpose vehicle, or SPV in short, owned by themselves, to buy back their corporate bonds and to report extraordinary profits. The issue arises if this SPV borrowed funds from banks to purchase assets from their parent company. If this suspicion holds true, the reported level of NPLs may not accurately reflect the actual situation, potentially leaving the NPL level at the same or higher levels. In light of these uncertainties, the AFC Vietnam Fund has prudently chosen to avoid exposure to the banking sectors for the time being. Furthermore, we are closely monitoring the market, whose liquidity is currently significantly below the record highs of 2021. We anticipate that speculative funds will soon take profits from the banking sector and move to other sectors. We also believe that we will soon experience a robust increase in the mid and small cap segment, which would align with our strategic portfolio allocation. Despite existing economic and banking sector challenges, Vietnamese stockbrokers collectively expressed optimism, believing that the worst is behind us. Projections from the major brokers indicate a bullish outlook for the Vietnamese stock market in 2024, with the average forecast expecting a 20% increase, closing the year at approximately 1,350 points. Among the brokers, VN Direct stands out as the most optimistic, forecasting a 28.4% increase to reach 1,450 points. Meanwhile, MB Securities adopts a more conservative stance, projecting a 13.3% increase to 1,280 points. The rising income levels and the robust economic expansion in Vietnam have further fueled the growth of domestic tourism, creating job opportunities and benefiting the rural communities. According to the Vietnam Tourism Department, the total number of local visits in 2023 set a record high of 108 million, surpassing the 2019 level by a significant margin. Well, this is all for me. Thank you very much for listening, and you're going to hear from me again next month with a new update. Thank you and goodbye.